Morning. My name's Colin White. I'm the founder of Credit Connect Media, the person who runs the event today, running the Credit and Collections Technology think tank. So I'd like to take a moment to obviously welcome you all. We've been running this event this is a fourth year, I think, face-to-face. We run them virtually as well. The idea behind it is we want to bring to the fore various discussions related to the credit and collections sector, and talk about them. One of the subjects you'll see today is not really covered enough, in my opinion, in terms of fraud and within credit and collections. So we'll be talking about that. But the idea behind it as well, sometimes we want to talk about the topical stuff that's behind the kind of the stories. So cost of living, obviously, probably bored of hearing that phrase, but it's obviously a factor. Inflation is related to that. And then we've got an interest rate announcement today. So no doubt that'll trigger something hopefully positive. So but I think we're now seeing a change in terms of the way we all live day to day in terms of costs and stuff. So we'll talk on some of that today across our various sessions. But firstly, I'd just like to thank the companies who make today happen. They really do, because we do have to pay for things and make sure it all works well. But on that note, please network with these guys. So you've got Acquired, Coeo, Depstream, Exus, LexisNexis, Moneyhub, Telrock, TCN and Webio. They're the guys who a couple of them have got stands, some of them were talking. Please take a moment to talk to them, because I think it gives everybody full value from the day. So appreciate that. Obviously, welcome to everybody who's made the effort to come today as well. In terms of what we're going to cover off, first session we'll look at credit and collections risks. Then I mentioned about fraud, impact on credit and collections, something we really want to talk about. The first time we've really talked about this at an event. I think it's something we need to bring to fore more and more. So that's the next one. We'll have a lunch break at 12:30. And then this afternoon we'll look at customer engagement and the role of technology. We've got some really, really good speakers from lenders and different collections companies as well. So hopefully you'll enjoy that. On that note, social media perspective, please engage using the hashtag that's on the screen there on Twitter X, whatever it's called now, and also LinkedIn in particular. We put a lot of feedback on there. And then Slido we've got in action. So between myself and Chris, we've created some questions and polls. So please log on to the app or go on to, I think it's sly.do, and on there, using that hashtag, and please engage, take part in that. So it's all anonymous. But some of that we will use and write up on the Credit Connect website next week with some reviews and some takeaways. That's what we always want to achieve from these events, is some really good takeaways in terms of the feedback. So, I'm kind of dashing in between two events today. Some of you might have seen, and you'll see it at lunchtime. It's a bit busier than normal. We've got a commercial credit and collections conference, different kind of topics, different kind of format. We're running a couple of round tables up there as well, just trying out some new kind of approaches at events. So you'll see some of the guys. There's a little bit of crossover, but please welcome them as well. But speaking of welcoming, I'm going to hand you over now to who's going to do the hard work today. It's Chris Warburton from RO Strategy. He plays a big role in helping inform the event and the speakers and stuff. So please welcome Chris to the stage. Thanks a lot.
Thanks, Colin. So as Colin says, welcome. So it's going to be a super interesting day today, and we're going to sort of kick off. So a little bit about my background. Chris Warburton, run RO Strategy. I spent the last 20 odd years, I suppose, in the collections kind of industry. Currently just doing a series of videos, which is really where sort of Colin and I interact, where we spend a bit of time sort of talking about some of the latest themes that are coming up, the latest tools, the latest technology, those kind of things. So that's really a little bit about what I do. I'm going to be the host for the day. We've got a great set of speakers. Throughout the day, we're going to talk about credit and collection risks. So, lots of risks really around that. We're going to talk a bit about fraud, as Colin was saying, which seems to be on the increase. So it seems to be kind of bubbling. Then we got a session after lunch around customer engagement, which really, a lot of collections comes down to engaging customers where and when you can. And then lastly, to finish off, we're going to talk a little about the role of technology. And the technology landscape just continues to keep evolving. So what's the latest and greatest that's kind of happening there? All the sessions, I think, are being recorded, so we'll look at that. And as Colin said, that we're going to post some polls throughout the event. Now, I did have a couple of starting questions on Slido. I don't know if we can just go to those, if people sort of like log on to Slido, just to sort of kick us off. So, well, here we are. What's the biggest risk you see in 2025? So I just look at the inertial ones that's coming up there. I don't know, how many questions have we got? How many questions have we got? There are a few questions that are coming up. So I think if we can just roll through the first couple, just as if we go back to the slides, just right. And I think you should see them within Slido. That told a lot about what happened this week, I think. So just as we're going through those sort of like initial kind of questions, I suppose I just wanted to take just a few minutes just to talk a bit about what's happened over the last year, just a real sort of like brief overview. This is where we were last year. So last year's events, if you were here, we talked very much around, the rising living costs, the cost of living. We talked a little bit about energy prices. There's a whole conversations we had around increasing digital communications, digital engagement, and of course we talked about AI. I think we talked about AI quite a lot last year. So that was last year. What's happened over the last 12 months? So what I do is I look through the headlines pretty much every day, and so I sort of like summarize some of the themes that we've kind of seen from a headline point of view. If you look through these are just the BBC headlines. If you look through those, really kind of what you see is, again, rising cost of living kind of came across. High borrowing levels was a key topic. Over the last year, we're talking about interest rates, worries about economic growth. And then, of course, in the last couple of months, we've always had the general election in the UK. We've had winter fuel payments that caused a bit of a storm. And we've had the UK budget, which I think we'll end up talking a little bit about. And then on the international stage this week, we've also seen further economic challenges with there's been a new president elected in the US, but also just even last night, the government in Germany collapsed as well. So there's going to be elections in Germany as well. So there's big things on the horizon that have been taking place over the last year or so. But of course, we don't have to just look at BBC. We can also look at Credit Connect. So we've got our own sort of like industry representation. And so what have been the headlines over the last year in Credit Connect? Again, inflation dipping below 2%. There's been this spike in council tax. There's been a lot of discussion around council tax arrears and how those are collected. And then we continue to see increasing headlines around, cost of living, 20% rise in utility costs, rise in fraud, 19% rise in fraud. And then recently we had this court ruling on motor finance as well, all of which I expect before we talk about some of these things today as well. Economic, regulatory stuff came up. This is what the regulator's been up to the last year. There's been a whole slew of stuff that's come out. I'm sure you're all aware. Just the amount of regulation and regulatory scrutiny just seems to keep on stepping up all the time. And it doesn't kind of stop. And we had the Borrowers in Financial Difficulty, was it PS24-2 that came out last week, I think it was. That went live, changed Conc 7. But next year we've still got, there's Vulnerable Treatment Review, we got the Credit Information Study, which will change credit bureau referencing. There's persistent debt, the product sales data that's coming up next year and the year after as well. So the slate of regulatory changes sort of isn't slowing down, it feels like. So hopefully we'll talk about a lot of these topics today. We'll get into a little bit more detail, and we'll see what people are thinking. I've been allowed to do one little plug, and this slide here, which is just for my. We do a trends and benchmarking, so Colin's part of it as well. So he's helping to sponsor some of it. If you want to take part in that, then we'll leave this up there as well. So if people want to take part in sort of getting some benchmarking data back as well. So please do take part. It's all free and anonymous if you want to take part in it. So onto the agenda. First one up is credit and collections risks. I put up there sort of like quite provocatively, is cost of living still a thing? Financial difficulties and vulnerability and regulatory scrutiny. Those are the sort of things that have been been bubbling. And I just want to welcome to the stage the first set of speakers. So we've got George Bronze, who's the head of business risk from Virgin Money. So George, you want to join us on stage? Russell Hamblin-Boone is the CEO of the Civil Enforcement Association, Chris Leslie, who's the Chief Executive of the Credit Services Association, and Rick Biggs, who's the Sales Director at Moneyhub. Moneyhub are in the open banking, financial data, fintech kind of space. So everyone, welcome. Thanks very much for joining me. And I suppose to kick off, I think we wanted to talk a little bit of reflection around all the things that have changed. And I was actually going to go to Chris, you first, in terms of like, the budget feels like ages ago, actually. I have to say, it does feel like ages. When we were talking on the phone only last week, the budget was the big thing. And we had a long conversation around the budget and sort of like, what's the impact for us? But it feels like it was a long time ago now. But for us, I mean, I know there's been international events that sort of superseded it in the news media, but I think for us, the budget's probably the biggest thing that's sort of impacting us. I mean, I was going to ask the panel's reaction, but maybe go to you, Chris, just first, just around how do you feel about the budget that's come out in the UK and sort of what that means for us and particularly for the industry?
Yeah, I mean, I think there's a lot going on, and the American situation isn't totally irrelevant to what happens in the UK. I think Kevin Still was just reminding me that every time we meet here, we're always expecting an interest rate decision almost imminently. And I think the sort of price of money issue will be back in the headlines, partly because I think, yes, the budget didn't really touch on our sector directly. In fact, actually, the budget didn't mention, for the first time in a long time, didn't really mention financial inclusion, and some of the sort of consumer credit issues were a little bit on the back burner. It did, though, of course, increase costs for all businesses, national insurance, employers being the obvious one, but there are other employment cost issues there too, which is why the OBR then projected a downgrade on disposable household income. So that they were projecting that actually it's going to be, over the lifetime of this Parliament, it wasn't that far from the sort of pandemic levels of low growth in disposable household income, which obviously does affect our sector. The ability of people to repay what they owe, I think, will be affected. And if you end up with a sort of global environment, as well as that domestic budget, sort of taking money into the state, crowding out private sector a little bit, but also passed on to employees, as it will be, the national insurance change. If you see, if we do see tariffs starting to go up, we see the wall going up in the States, the sort of sucking of capital out of Europe a little bit and into America, we might actually start to see inflation begin to pick up again. We might actually see interest rates not necessarily coming down, possibly staying the same or even rising. So we might be in a little bit of a turning point in the cycle. That's my feel about it.
So the concern is really, I suppose, from a budget point of view, is when will that flow to the economy, how will that flow to the economy, and then even external events as well. What does that mean for UK PLC in terms of economically, and then what does that mean in terms of lending, I suppose? George, do you want to, what's your kind of view from a banking point of view?
And that's probably it, right, is that from a lending perspective, I think there's two sides of the coin. So for consumers, particularly in the mortgage market, we've been through an extraordinarily high period of stress rates for consumers, so the access to credit for the housing market's been really difficult for the last couple of years, and yes, regulatory changes have made that a little bit easier, but it's still extraordinarily hard for lower income families, lower income households to get onto that property ladder. And we do know that ultimately sort of house buying activity is a big part of the economy, big part of UK PLC. So I think that sort of outlook on what it means for the rate environment, what it means for sort of, customers' ability to access lending for housing, I think there's a bit of uncertainty there. And then on the flip side, I think that, for those customers who already have lending, particularly in the business space, national insurance hikes weren't unexpected. I think they were well signposted, but there are some implications that need to be worked through. And I think that for a lot of smaller firms or the smaller businesses, what it means for their hiring plans, what it means for their likelihood to continue to borrow, I don't necessarily think that at this point, from what I'm seeing in the trends in kind of our customers and within the market, there's a clear view on what it means. It's just extra things to work through at this point in time that I think is just going to take a little bit of time to understand what the longer term implications are.
So it still feels we're in sort of like wait and see mode at the moment in terms of how that then kind of flows through. I mean, we talked a bit about Cost of living, we talked a bit about last year, we talked an awful lot around that, and arrears levels. I mean, I've been sort of like hearing that arrears levels have been sort of like relatively flat. So I haven't seen sort of things like fall off a cliff, really. I mean, is cost of living still an issue? I'm going to sort of say, I know we saw it in the headlines there, but I mean, is it still an issue? And Russell, I was going to ask what your guys are kind of like seeing, and like your members are seeing as well.
So
you see a certain aspect of that.
Yeah,
right?
and I'm mostly involved in public sector debt collection, which is in most cases priority debt. And actually, you had on there sort of council tax arrears. Council tax arrears haven't changed dramatically. In 2019, there was we had about 1.5 million cases passed to enforcement agents. Last year, it was 1.6 million. There was a big drop during the pandemic, but we've kind of levelled out, and councils are, recognising that they have to, what we would call in the credit sector, exercise forbearance. But that has got to be married up with the fact that there wasn't a lot in the budget for local authorities. There wasn't a lot, while apparently we're not having austerity, actually there will be a lot of austerity measures applied in the public sector in local authorities, and they will also have to ramp up their collections activities. They've got to find revenue streams, and there's £6 billion worth of uncollected council tax debt alone, despite all of the other revenue streams and debts, arrears that the public sector has. So on the one hand, the cost of living crisis is affecting people, and councils are trying to respond to that sensibly. On the other hand, a lot of the services that are going to help people through the cost of living crisis need to be funded, so therefore they've got to fund it through local taxation.
And it's a similar story in the consumer market, right? So I led the unsecured credit risk teams for a while, and that sort of adaptation to the market is what we're seeing for consumers. So, consumers are adapting their consumption to be able to still meet credit commitments. So certainly in the unsecured space, that lagged effect of arrears has certainly been the case, and we haven't seen huge rises that probably everyone 18 months ago thought, oh Lord, there's going to be a massive drop-off, massive cliff edge. It is clear that from the kind of current account balance of consumers, there's an adaptation to that spend, but I guess the question is, how elastic is that, and how far can that continue to go before you do get a bit of a break in it?
Some of the data I've seen has been kind of interesting in terms of it depends on which income decile you're at as well. So some people are more stretched than other people. Some people have been able to absorb it, and just where that's kind of changing. I mean, Rick, you look at a lot of like data, I suppose, have access to some of the data. I mean, what's some of the data that you've kind of seen?
Yeah, we do. So obviously we're an open banking solution provider, so we're engaging consumers or customers, if you like, our customers, on an open banking journey, which opens up their bank account. So we take the transactional data, categorize it, and we're getting those insights, and we can categorize, and we do categorize it, and we look at essential and non-essential spending, for example, and we do see changes, and we also survey consumers, and what we see, of course, is different cohorts of consumers who are, some are very challenged, and we see changes in behavior and how they spend their money, how they manage their money, and also seeking additional lines of credit to actually meet existing credit commitments, which is very worrying. And of course, there is an industry around that as well. We see an increase in buy now, pay later, for example, as a credit product, and that's people managing their money and trying to manage their money over a longer period of time. So interestingly, it's consumers applying their own collection strategy or managing their debt, if you like, and meeting those credit commitments. But yeah, we do see, and we get a lot of insight into the detail. And what we've seen is, in terms of the crisis, we see that people are taking more debt. They're looking for new lines of credit. Very challenged, some of these people, to get those lines of credit, which puts them into very vulnerable positions. And we see vulnerability indicators in the same transactional data. So we see income shock, for example. So we can see that somebody's income has dramatically dropped. That obviously has a massive effect. We also see on the conversely, we see people getting a pay rise, and that changes the equation for them. So we have those insights, and they can be used to manage customers, to communicate with your customers, and apply the right strategies in terms of, you know, each customer and what's right and what's a good outcome for them.
But, yeah, I mean, there aren't going to be many pay rises, I suspect, in the next 6 months at least anyway. A lot of businesses, you know, where will this NI employers situation go? Well, it'll absolutely scale back bonuses, it'll scale back pay rises, even headcount issues will start to come into the frame. I mean, you know, putting a bit of politics around this, change of, you know, it was very important for a Labour Party in opposition to absolutely hammer cost of living, which put it on the media headlines. It meant that the regulators were very focused. You will find that in government, the Labour Party won't want to necessarily talk about a cost of living crisis anymore. Yeah. It wants that to, and that's why we didn't see that theme in the budget at all really, because it's now, you know, politically less expedient to shine the spotlight onto it, but it is still there, right?
So, I mean, it seems like economically, everything's been stretched. People have been stretched, and people have been sort of like managing to a certain extent. So some people who can manage, and some people who aren't able to manage, and they're finding new ways, such as like additional routes to lending, saving in certain areas, those kind of things. But it feels like it's getting stretched even more, and I suppose then we have to just watch what happens over the next sort of 6 months to see if does the situation continue, does it get worse? I mean, what's kind of like the outlook? I mean, what do you think the outlook is? I mean, what should we be ready for?
I think big picture, right? At the macro lens, sort of wage inflation has finally been outstripping sort of inflation for a while. But I think your point's really valid, Chris, is that if you look at the distribution across households and income decile, there are very, very different lived experiences for different segments of consumers. And I think that's the bit that I think from a collections perspective that we've got to recognise even further, is how you address those differences of experiences, difference of income bands, difference in kind of affluence that, you know, a typical ABC collection strategy just can't deal with anymore. And those sort of regulatory expectations are just getting higher and higher and higher, rightly so. And the complexity of the situation for each consumer now is very, very different to maybe sort of a can't pay, won't pay strategy that maybe existed in the past. I think that's probably one of the things that's really difficult for lenders, particularly, you know, speaking as a sort of larger lender, how we adapt those processes, how we adapt those strategies in time to be able to provide the support at the point that that consumer needs it. I think that's one of the real difficulties.
And I suppose I wanted to now come on to, I suppose, you know, this doesn't necessarily happen in a vacuum, and particularly with the new government that's there, but I mean, regulation's been on the plate a lot. And I'm just looking through, we've had PS 24/2, borrowers in financial difficulty. There's been a raft of portfolio and CEO letters that have gone out around Consumer Duty, which is now live. We've had a whole raft of fines that have come out around vulnerable financial difficulties and vulnerability treatment. I mean, what are the hot topics? I mean, what have we got to be aware of in an industry? As Chris was going to go back to you in terms of like some of the things we've got to be aware of. I mean, like it feels like that regulatory kind of focus is almost like tightening to a certain extent, and to a certain extent it might be a reaction from some of the economic pieces as well.
Yeah, I mean, what's happened in the last year, this is the theme you started, we've had 19 different FCA publications during 2023. Cumulatively, that was 1,560 pages of new regulation that you either had to respond to or be aware of. That's a couple of hundred pages more than Tolstoy's War and Peace. Yeah. And you're not statutorily obliged to read War and Peace if you don't wish to do so. So, you know, you are talking about an awful lot of change that has come through that regulatory pipeline. I mean, obviously, you know, everybody's adapting to Consumer Duty. And we're still waiting for where that enforcement action is going to be, and that will be what everybody's watching, the appetite of the FCA to intervene. The big issue for debt purchase in particular, but creditors more broadly, is actually the Financial Ombudsman Service and their various interpretations of the Limitations Act, what's going on commissions generally. Motor finance is going to be under the spotlight this year. And a lot of that anxiety, unknown liability risk, especially in terms of, you know, potentially retrospective redress, is a big blight, is a big cloud hanging over a lot of the credit, the non-bank sector, and is affecting the investability of the sector. If you're in private equity or elsewhere looking at this sort of environment, that big regulatory black cloud means you think, well, I'll tell you what, I'll just sit this out for a little bit of time, because you just don't know what you'd be taking on and the redress risk that you're taking on. So that's the big focus as we see it currently. And it's maddening, because actually, ironically, the FCA is almost sort of in a slightly better position. I feel as though the FCA is kind of starting to come through in a mode of engagement and wanting to understand, because the government in particular is saying, we want growth, we want you to have a growth focus now. But what kind of growth can the sector provide or support, even to the wider economy, if its ability to lend is going to be so constrained because of this big regulatory black cloud? So, in a nutshell, that's the sort of environment I think we're currently grappling with.
I mean, it doesn't feel like the environment's going to change into next year. If anything, it's going to be more like this. I mean, Russell, just you talked a bit about council tax collections there. There's been a lot of sort of focus on that externally, but I think that I saw some stuff from you around, like how do we respond to that? Because there's a lot of pressure on us as an industry to say, well, look, collections gets broad brushed as being terrible, but in fact the reality is somewhat different, right? So how do we best sort of like defend ourselves from that in terms of, or already respond to that to sort of put our best foot forward?
Yeah, well, it's probably unpopular opinion because Chris is sort of bigging up the FCA there, and I'm not that great a fan of the FCA as it stands at the moment. It might be popular opinion, I don't know. But it seems to me that we're trying to intervene, and in doing so, we're stifling the change and the flexibility that's required to adapt post-pandemic, and we're still trying to apply the same models and not allowing the parameters to be broadened enough for risks to be taken. We're kind of asked. We need to sort of ask ourselves the question of whether we want kind of like regulation to be the difference between the UK and the US policing, for example. In the UK, it's about crime prevention. In the US, it's about law enforcement. And do we actually need to be a little bit more law enforcement than crime prevention? Because we're trying to, in some way, mitigate for people's behaviour. And people's behaviour hasn't changed a great deal since the pandemic, but the economy has changed. People haven't responded to it, and then we get to sort of pick up the pieces off the back of that in terms of people's arrears, in terms of their financial situation, and then there's interventions to try to change the way in which we do that. And I kind of think that maybe we need to look differently about whether we're trying to regulate to prevent problem debt or whether we're trying to regulate to prevent a more broader harm to society, because we can't actually do both effectively.
But I think also that, I mean, if we're in the environment we're in, where the outside of any lobbying that can be done, how do we as an industry respond to what they are imposing on us, given that they are the regulators? Is around evidencing what we do, trying to stay ahead, those kind of things. I mean, and all this adds to cost, doesn't it, in terms of like cost of compliance? And George, I mean, I just ask you just as a lender as well, which is, I mean, it adds to that regulatory burden that's kind of going on. How do we best respond to that, in as much as rather than just ticking the box and doing whatever's been said?
Yeah, exactly.
Stay ahead of it.
The sort of the cost implications are enormous, but I think it's a really good question about how you respond to it, because I think there's almost two different approaches that seem to be forming from a regulatory landscape perspective. The more principle-led approach that Duty tried to implement, which was very principle-led, evidence yourself, get yourself comfortable, and make sure that you've got the things in place that can satisfy yourself as an SMCR or MRT that tells you that you are meeting that principle-led. And then at the same time, I can't remember the number of pages of documentation. Well done, Chris, on that one. But PS24.2 then follows, which is a little bit more prescriptive, and it feels like it makes it really challenging to know how to navigate it from a regulatory environment perspective, because it makes it, to Russell's point, like, are you trying to go down this avenue? Are you trying to go down this avenue? And the interpretation element actually is probably one of the most challenging things for a larger lender, is actually thinking about the complexity of our landscape and all of the processes and strategies that we've got in place, and trying to think about, we've been through a huge exercise that's been more principle-led focused, and then put a prescriptive lens over it at the same time. It makes it really difficult. So I think that's the bit that, as an industry, it's how we navigate collectively to best tackle the FCA's view on, do they want to go down that prescriptive route? Do they want to go down a principle? And that clarity will just be helpful.
But there is this regulatory schizophrenia if you take regulator as FCA, FOS, government, if you in the round, because you do have them saying, we want you to be adults and grown-up companies, take self-responsibility, principles-based, you decide what's sensible or not. That's the consumer duty ethos. It's actually quite a good thing to try and get away from infantilizing firms so that they have to be told absolutely. But at the same time, you've still got the Consumer Credit Act, nothing on the horizon really about reform of that. I mean, the Treasury working groups a little bit, and all these prescriptive rules-based stuff. And actually a lot of firms still cling to, they want rules and the statutory notice provisions and prescription, because at least there's some certainty about where to, which line not to stray from. And so it is that sort of, what do they call that? The prisoner's dilemma. Even though the cage may be opened, there's a reluctance to walk outside in case something else, some other regulator, snaps them up. And
the amount of meetings that we sit in and say, oh, should we just ask the FCA what they mean? And we know what the answer will be. It's like, well, what do you think it will mean? Yeah. But I think let's take Mortgage Charter from sort of last year. That was a really good example of the challenge, that it was so prescriptive but then also so vague at the same time, and trying to get that implemented at pace, when we as lenders were sort of sat there saying, we already do all these things already exist, we already offer temporary interest only, we already offer term extensions, we already do all these things. And it felt at that point in time like, is this a political play, is this really something for consumers? I mean, I know what the answer was and I'm not going to say it, but it really shook a bit of faith in that regulatory landscape, that you're trying to do something that's consumer duty, principle-led, and then, by the way, here's 4 things you need to implement that you probably already do in some way, shape or form. So I think that's the challenge, is supporting the FCA as best we can to navigate that route and say, do you want to go down a principle? It's the grown-up way to do. Post-2008, you've got a massive change in the financial services sector with big risk functions, 3 lines of defence models, left, right and centre. Trust it and regulate that, as opposed to being very, very prescriptive.
And I suppose evidencing compliance, and I suppose data and the role around that, I mean, that seems like that's ever expanding. I mean, and Rick, come back to you just in terms of like how you're seeing that play this part in terms of, evidencing compliance, really. I mean what are you seeing? Because there's a whole new wealth of data out there, and to a certain extent it feels like the regulator's expecting that as well.
Yeah, there is. There's all these data points that we provide as an industry in terms of open banking through categorized data, and then that's available, and it's used for managing customers, engaging customers, communicating with your customers, and also evidencing. So what you do can be evidenced. And those data points can be used. So we're prototyping right now a consumer duty dashboard, for example, for our customers who can plug into that. So, starting the journey from perhaps originating a credit application, managing a customer through the life cycle, obviously engaged those customers in open banking journeys throughout, and then evidencing through that dashboard, because we see that as an opportunity of a rich data that can be used for good outcomes, and good outcomes include, for the lenders, doing the right thing, but also giving you an opportunity to do the right strategies and collections, which means you haven't got a debt that can't be collected. Maybe it's a change in that collection strategy for that individual customer, or it's an upsell, cross-sell opportunity. But if you can evidence using the data points, and you can prove the regulator doing the right things, that's what I think you need to do, and we believe that that's a service that we can provide.
Yeah. Russell, do you want to just comment around your sector as well?
Well, yeah, I mean,
because I think you've done some stuff around that in terms of like proving that what you do is in the benefit of the customer, or is not causing customer harm. Yeah,
priority debt is one of the biggest causes of problem debt, whether it's utilities or whether it's debt to the government, and utilities are sort of slightly ahead of the curve from government debt collection, and we're trying to catch up. The government is sort of pushing everything into the private sector, getting enforcement firms to use all the tech that it doesn't have to pay for, because the enforcement firms will do it for free. And but it's now starting itself to look at what data it holds and whether it can use that more smartly. Very belatedly, it's looking at what everybody else is doing and thinking, well, perhaps we should be doing more of this thing called sort of data analytics and whatever. In the budget, just going back to the original question, the HMRC has been given £12 million to buy more CRA data, which seems a very small amount of money for what it should be doing to be able to understand people's financial situation. And so we've got a situation where the government is starting to recognise that different departments all impact on somebody's household income. Let's just, a simple case. A local authority, you might have a parking fine, you might have a council tax arrears, but the collections, the revenue people collecting the council tax won't know that you've got parking arrears for exactly the same creditor, the local authority, because those two departments don't talk to each other. And on top of that, those local authority collectors won't know that you've got other debts or claiming other benefits from central government, because they're not talking to each other. And the process is there. The Digital Economy Act allows that data sharing. The government hasn't yet. They're doing pilots and things like that, but belatedly they haven't worked out how they can share this data and create a picture. And then the next stage would be, how do you share that with people in the private sector that also need to be able to form a complete picture of anybody. So we have a situation at the moment where priority debts like council tax arrears don't feature on your credit score. So particularly young people are deciding, well, I don't need to pay my council tax arrears because that doesn't affect my credit score. I definitely need to pay my mobile phone bill or my utilities or my credit card. And so they're prioritising sometimes non-priority debt over their priority debt, which has greater consequences.
Yeah. It does feel like this theme of data sort of continuing to build, either from internally in terms of what we report back, but then also externally as well. I was going back to the product sales data and the credit information market study that's also coming out as well, which so they're looking at line level data that's going to be asked for. So the regulator's going to be asked for that. We're being asked to use that to reflect it. And it feels like it does kind of feel like it's all going around data and getting our data correct. I don't even want to comment on that. Maybe I'll go to Chris to comment on some of that stuff.
Yeah, I think the sort of data landscape within sort of credit risk in general, but in collections, is getting more and more sophisticated, to the extent that a lot of lenders like ours, and I'm sure many others, will be structuring their data teams very, very differently to how they would have 5-6 years ago, where it's much more defined remits around data governance, data control, data production, et cetera, et cetera, et cetera. So I think that's a good thing, because I think, the piece that Russell talks about there, that's true in larger lenders all the time, right? Being able to manage a customer with a single customer view, even internal to a bank, is sometimes really challenging, let alone then trying to pull in data from other debtors, other creditors, and trying to understand truly what that customer's position is and ability to service their debt. What I do see, though, is lots and lots of really interesting firms in the market that are sort of designing ways around this, and I think that that's really exciting to see that the market's responding to that need. So you see, I&E providers developing solutions that bring that together with a real customer focus, with a real, this isn't to increase collections rates for banks. That's a byproduct of actually just making it easier for consumers to deal with the debt that they're in. So I think the data landscape is getting more challenging. I think lenders are responding to that appropriately, but it's actually burgeoning up little industries within the market. That's actually a really exciting solution for the collections and credit space.
So Chris, just before we move off the regulatory piece, I'll just comment around what's coming down the pipe at us with the data piece.
Well, the product sales data rollout, certainly for debt purchase, is sort of coming, I think, in the spring. But the FCA are currently consulting on extending that to collections agencies, even to debt counselling, debt advice. So it's this is the FCA on a massive data grab. They want to be a data-led regulator. Well, that sounds good. But for those of you that thought that was just sort of aggregated MI, it's way beyond that. It is that account level, postcode level, quite intrusive, in my view, overreach from a regulator, which is almost becoming a sort of nationalised credit rating reference agency of its own, to have that level of data that they're going for. And I'm, even if the FCA, and I'm sorry to bang on about, you almost you characterised me as a cheerleader for the FCA before. I'm just saying that it's mildly better in some of their engagement in comms, but they are a leviathan of an organisation. I mean, you have 5,000 staff at the FCA. All of your fees and levies, of course, will continue to go up in the next round, and but they'll take on more staff because do they have the analytical capability in house with all this data that they're going to take through PSD to actually inform their enforcement judgments? I'm not convinced. I mean, anybody at trade associations, we try voluntarily to get data from our members from time to time, and different members will interpret a question of a field in a different way, or, well, did you mean that type of credit or that type? They're going to encounter that manyfold, and I do worry about enforcement decisions chasing down different data rabbit holes when actually it's not necessarily based on reality or on partial returns or however. So this is a big, expensive decision of the FCA to develop its enforcement approach through that level of data change. And a lot of people are not aware that this is coming.
Yeah. I mean, Rick, what's your kind of advice, I suppose, in terms of how do we now start thinking about data? I mean, you guys do data every day. I mean, how do we start thinking about getting our house in order to be able to respond to some of these changes that are coming at us?
I think I always feel a bit ironic saying this because I've worked in the credit reference agency industry during my career, worked for all three actually, at different points in my career. But I think that, and to your point about different government agencies and accessing CRA data like HMRC, of course, CRA data has a place, but I think generally, if you're looking at ID and affordability and trying to assess a customer, it's not up to date. It's not real time. So it's not giving you that view today. What's my affordability in this moment? What is it tomorrow is different. So I think the new data sources accessible in real time is what's required. That doesn't mean that CRA data doesn't have a place and disappears. What it means is new data sources should be used as well as part of a decision, whether it's approving credit or it's a collection strategy or just managing a customer in life, because you should be managing customers in life. It shouldn't be one time at the beginning of a relationship.
Yeah, I mean, absolutely. And I just feel like things are, lines are getting blurred as well. So this whole piece around financial difficulties and vulnerability seems like that's sort of getting combined to a certain extent. They used to be very separate. When we come to these conferences 3 or 4 years ago, I mean, they're almost like separate streams to a certain extent. It feels like everything's kind of getting joined together. How do we sort of start to think about that in our process, and how that's going to impact, particularly things like complaints, but also escalations and putting people on forbearance plans and process kind of dynamics as well. I mean, George, how do we think? Because it feels like it's a new landscape that's sort of evolving or has been evolving.
Yeah, certainly through my career, there's a big shift that we don't even talk about collections as a separate thing, right? It's sort of managing customers in financial difficulty. So even the language is changing to sort of support that. I do think that one thing I do agree with in the regulatory landscape is that it's made it really clear-ish that there is particular accountability. So firms are being more and more clear today about who is responsible for that customer's life cycle throughout their end-to-end journey. And that, I think that's a really good thing because it makes it really clear about who's on the hook for that customer onboarding through the life right to the end of their journey for any credit lending perspective. And I think that accountability where we sort of, and this is one of the things that came through in the fine that I think HSBC got, was that it's becoming, committee structures are all well and good, but you've still got to have someone on the hook in a firm who is responsible for that. And I think that's making it clearer internally to know exactly the process. And that's why I'm really big on the principle-led approach, because each person who is accountable for that customer might have a slightly different view on exactly how best to get good customer outcomes, but it gives them a degree of flexibility and keeps competition in the market. So I think that's one of the things that I see that's evolved, and you don't have this sort of disaggregation of, well, this department's sort of responsible for this bit, this department's responsible for that bit, this department's responsible for this bit. And if everything is green in each department, everything's okay. No one's then looking at the whole journey in one go. And actually you've got a bit of a clarity in the regulatory sort of accountability framework that means that there is a name against that journey end to end, and they need to feel that accountability day to day.
Yeah, I mean, Russell, what's your kind of view in terms of, I suppose, that sort of blending together and identifying? It feels like we're much more sort of like, I mean, it's customer-led rather than sort of issue-led.
Yeah, I mean, probably another unpopular opinion number 2 is that, yeah, we've defined vulnerability so broadly now that we're trying to spread mitigation of vulnerability so thin that actually it's ineffective for most people, rather than targeting our resources at a tighter definition of what's vulnerable. By virtue of the fact that you have debt, arguably you're vulnerable for one reason or another.
Yeah. How much do you think the fact that we talk about it, and it's talked about sort of in the public sphere, not just us talking about it, but in the public sphere, that it creates more of an issue in terms of people flagging things? Do you think is there a connection there where it becomes a bit of a feedback loop?
Well,
do you think?
The industry I'm in, you know, you put bailiff in the headline and you've immediately created a fear factor about debt. You've stigmatised the person that has debt, and you've also cut off any communication channels or opportunities. I know there's a session on engagement you're going to have with that person, simply because you've demonised the whole experience, rather than turning it around and saying this is an opportunity for help. This is an opportunity to fix something. Instead, it's had the opposite effect. And in the public sector particularly, there isn't the flexibility to change what you owe. You know, the process of how much your billed or how much your fine is or your penalty is has been decided at an earlier stage either by the courts or by means testing. And when it comes to collection, there's no flexibility to say, well, actually, just pay half of that and we'll let you off the rest of your council tax. You know, it's decided, it's about the point you were making. It's as Rick said, it's an ongoing relationship with the customer. The public sector doesn't want that ongoing relationship. It wants a one-off. Let's get this done within this financial year, and then if you move out to another council area, we don't have to have anything to do with you ever again. And so it's a very different dynamic, which means that it's very easy to criticise the way the government collects its debt as sort of aggressive and forceful. But actually, you know, my argument is what I said about perhaps we need a bit more law enforcement and a bit less crime prevention.
There is always a joke internally and in various other firms that if we did some of the things that LA's did, the FCA would really come down hard very
absolutely.
quickly.
And that's my point about the FCA hasn't the lived experience of people who were experiencing that kind of debt. You got me on my soapbox now, because you know, I used to represent the short-term lenders, and the FCA took a sort of a middle-class value judgment about the product that people were using, and decided to chuck the whole thing out and creating a market for illegal lending. And you know, it's exactly the same thing. Cohorts, different types of people, cohorts of debt. There's a new cohort of debt which I see when I go out with enforcement agents and up and down the country, and I go out knocking on doors with them, usually behind them. And so many, virtually every other, Birmingham, Bournemouth, Brighton, Bristol, another B. So many times, every other case is a young woman who was, you know, a professional with a professional partner, and the professional partner wanted the flash car and the big telly and the statement dog and the gym membership, and put all of that credit in that young girl's name because she was in love. They have a baby, so she's restricted on what she can earn. He's taken a flip because he can't live his bachelor lifestyle, and we're turning up at the door of young women who've been let down by irresponsible young men. And I think it's a reflection on society post-pandemic. You got me on my soapbox. It's your own fault. But you know, this is an issue that is going to sort of feed through to other, other people are going to see in debt collection as well. that priority debt has been what my point about credit scoring, and there's a new cohort of young people.
So, Chris, I was going to ask you just a bit about cohorts, right? So there's also in the background, there's potentially, almost like you get these, stories can be in the media, and you talk about putting bailiffs in, and there's a perception in the public. And, you know, does that then lead to a political reaction that then leads to more regulation, and does that add extra cost? And, are we actually looking after the right treatment for the right cohorts? And because there are some cases that are really tough, and you've got to help people out.
Well,
right?
from time to time,
what's that dynamic that's kind of
you
going
do
on?
get from time to time the government will, or regulators will, sort of, you know, say the right things and spot some of these issues. I mean, Russell's absolutely right. This as it's now termed economic abuse. This concept of individuals exploiting others, you know, exactly, you know, it's a really good example, I think you gave, Russell, of what actually does happen in the real economy. But of course, regulation and statute doesn't distinguish in the right way. And I mean, it's why both of our, you know, whether it's on the enforcement side or the collections sector more broadly, we are all trying to constantly impress on government and regulators to focus on engagement. That dialogue, that conversation with customers, with the public, is the route to debt resolution if you want to do it. And yet, there isn't really that appetite within government or others to properly grip this, whether that's because they don't have a proper way of focusing on financial literacy or financial education. That's still in abeyance. You know, we talk about national curriculum and financial understanding, but nothing really changes on that. And Money Advice and Pension Service, FCA, in my view, should be encouraging conversations with the public, to be advertising, to consumers, say, you will get a better outcome if you pick up the phone and have a chat with your creditor, with your bank, with your enforcement agent, with your collections agency. It is in your interest to do that. They are well regulated. They will help, signpost you to the right place, get you into that solution. Instead, what do we get? We still have this, gut instinct, tabloidized media reaction about the evils of debt collection and bailiffs and all the rest of it. And it's there are different players in this sector. I mean, our good friend Martin Lewis is very good on the television in many ways in terms of helping people find good deals on utilities and all the rest of it. But there is also sometimes a bit of a sensationalism about, I'm being as diplomatic as I can, Russell, sensationalism on some of these issues. And you need voices like that to say, do you know what, it's okay to have conversations and engage. If you want to solve your situation, this is the way to do it. So we've got a lot to do to change that, that misconceptions and some of the myths that are around our sector.
I think that was one of the things that, again, I go back to Mortgage Charter as the anecdote, was that as part of the sort of UK finance response to that and thinking about how we best encourage consumers to talk to us, actually their research found that the biggest blocker was because people thought picking up the phone to the lender would impact their credit profile immediately, regardless of what the conversation was, regardless of what the outcome was. So there's a big piece on education. But I think Russell's anecdotes just highlights the point that I made right at the start, that the lived experience of each consumer through cost of living is so different. I think that the market is doing a good job in adapting to that. It can do more, it can do better, but the regulatory environment needs to keep pace. I think that's the challenge.
Rick, I was going to come back to, as they like technology, I mean, we talked a bit about data, I mean, but where do you sort of see that offering solutions to some of the things we've talked about? I mean, you talked a bit about open banking there, but I mean, where do you sort of see it sort of taking us?
I think it's going to mature. I think it is maturing. We see more and more consumers consenting to those journeys, therefore they're choosing to share their data. Not necessarily when they're stressed, i.e. maybe in collections, that they're choosing to do that. And I see it as, it will evolve, and it's democratizing consumer data and consumers making that decision to share their data. Now, I also think it leads to, and it should lead to, a value exchange. And that doesn't mean you're going to pay consumers for accessing their data necessarily, but there should be a good reason why I want to share my data. And that might be because I want a loan or I want a mortgage and I need to demonstrate my affordability during that process. If I understand the equation, because the messaging's right and the engagement's right, I will do that. That should be across a credit and customer life cycle, including in collections. If I'm stressed because I owe money and I can't meet my commitments, I think your point's really good, and I love the fact that you say that, you know, it's treating that customer in your organization, your bank, that's not being treated by different functional areas or silos, that your customers are more likely to pick up the phone, therefore, I think, in a collection situation and say, I have a problem. And maybe it's a temporary problem. Can we figure this out? Can I have a holiday? Can I extend? Whatever the treatment is. And I'll share my data to prove that. So I think that's what we're going to see. More consumer engagement if you get the messaging right. And it's about the value exchange.
But that consumer engagement might come more electronically as well, which comes with its own challenges, especially as we're all embracing AI. One of the things I think about is, you know, with some of the sort of class actions and PPI and motor finance, if we embrace AI too much, will the regulators start to come in and say, well, now we're going to retrospectively apply some accountability that you should have applied when you were, you know, adapting AI and it was evolving, because it's moving quicker than any regulator can catch up. It's moving quicker than most of us can keep up with.
The whole retrospective piece we were talking about before, I mean, that's really quite concerning, right, in terms of like when is it limited versus not?
Well, that is worth just dwelling on for a minute, because essentially FOS, acting as a regulator when it's not really supposed to, has essentially interpreted the Limitations Act of 6 years from the event being complained of is gone. It's now unfair relationship goes right the way back, and that's essentially a bit of retrospective regulatory change. I was trying yesterday to sort of, you know, tweak the FCA a little bit and say, you know, why are you letting the tail wag the dog here, FCA? You know, you should. This is a wider regulatory implication. This isn't something you should leave to FOS. But and I think FCA do know that, and FCA have also. You know, they've been landed with the motor commission issue, even though they sort of solved it because FOS made this set of decisions. So there's interesting politicking going on within the regulatory fraternity.
So we're almost at time, and I will come back to see if there's any questions at the end. But just before we do, I was like, where do you see us sort of being for the next sort of 3-5 years? I'm going to go around all the panel just to finish off. George, go first.
So I think that I come back to the question that you put on the board is cost of living. I think you did it facetiously. The cost of living crisis is absolutely still with us. It's latent. The impacts of that are still yet to be felt in terms of arrears levels. And I think that managing that over the next 3 years, certainly the consumer market, is going to be challenging still. And I think that if I put my business credit hat on for a second, I think that the sort of shift in terms of approach of government is going to lead to some sort of collections practice differences, some challenges within the business, in the SME space particularly, that I think we're going to have to stay really, really close to if we want to get to this growth agenda, and if we all still believe that one of the levers to do that is to have a healthy and vibrant lending community. And I think that's the two big things that I still see being on the horizon for the next 3 years.
Yeah. Russell, what are we going to watch out? What are we going to prepare for and watch out for? Where do you think we're going?
Yeah, well, I mean, the point I made about sort of retrospection of action for where people have used AI and it's decided that it wasn't used appropriately in time. Yes. I think one of those things, I think home ownership is going to change as well. So arrears are going to be much more generated by things like rent and maybe new type of rental models to allow people to, in some way, be able to live in their own home and afford to do it. Because I think, you know, we relied on the banker mum and dad sort of the generally, and I think the banker mum and dad of that generation is starting to run dry. The credit crunch, you know, we hadn't even got out of that before we hit the pandemic. The cost of living crisis is going to continue to affect us in different ways for, you know, another decade, I think, before we come out the other side of that. So the way in which we live, the way in which we generate our debt is going to change, and I think it'd be less about mortgages and more about young people managing rent.
Yeah. Chris, what do you think the outlook is?
Well, I wish it were a set of policies that were really serious about growth and recognise that the consumer and consumer spending is absolutely central to the engine of consumer growth. But unfortunately, there isn't currently, unless something changes, the recognition that credit plays in supporting the wider economy. And so what we're facing is an environment, partly because of this regulatory morass and the anxiety over liabilities, where a lot of creditors are going to retreat from certainly subprime, near prime. Prime lending, you know, you'll still have something, but even there, you know, you try and go and buy a car and get a car loan, good luck. You know, a lot of the showrooms have been told, you know, there's no PCPs and all those other things still out there. So if you're a cash buyer, you're in probably fairly good position. But who's in that sort of situation? So I worry about the retreat of credit availability, and of course, if there isn't the credit supply that's out there for collections, obviously that's going to have an impact as well. I think our sectors do pretty well. Actually, in terms of compliance with the regulatory requirements that are out there. So I don't feel as though it's fair that there's some big scandal or something to be uncovered there. I just wish that we had regulators and policymakers who recognise the value of credit and even collections as well as part of that cycle, because it is actually essential to the growth agenda. And I think we've got to persuade ministers and others about that.
And Rick, what's your sort of outlook?
No surprise, data would be my response on that. But more and more data available, more and more data having the ability to productionize that in decisioning. I see that coming. I think, you know, to your point, it's a really good point. Rent is a totally legitimate cost to people, and it's a totally legitimate and should be part of credit assessment, and yet it's generally not available in terms of validating it. So, you know, we should see that. And we should see those sorts of data points coming to market, because it is a changing landscape for a lot of consumers. And you are absolutely right that, you know, my generation, we've had a much easier time than I think than the generations coming up behind. And we need to pivot as an industry and recognize that it is very different for them, and their ability and access to credit should be there, of course, but the decision points might be different, and we need to recognize that, enable that. And it's also ultimately going to be about consumer engagement, I think.
Okay, well, thank you very much to the panel. I don't think we could just quickly flip the questions on just to see if we could get any questions on Slido, just real quick.
Maybe no.
I know we're sort of out of time. So these are some of the questions. I don't know if there were questions that had come through. So
Some Q&A there, something on top.
was the Q&A? Is there any Q&A on Slido? Just looking to the team over here. So if we don't get to the questions, what we will do is we'll make sure that the panel get to answer them as well. So we'll you know, Colin will send something out just to sort of briefly explain some of the yeah, hopefully, yeah.
Everyone's getting an essay.
So yeah, so thank you very. Let's have a hand for the panel. Thank you very much. Don't leave now. There's going to be a break, I think, after the next one, so we're going to go straight into the next panel. So thank you to the panel, and we're going to bring the next kind of panel up.